Hi, good week to all. This is Kelvin here again. Welcome to this week's latest edition of our weekly technical outlook for the week of 17th of January to 21st of January 2022, where I'll be covering the latest trend bias, medium-term trend bias, as well as key levels to watch on the various major stock indices across the globe. From the US will be the SPX 500, the NASDAQ 100, and over in Asia, Hong Kong 50, Japan 225, and Europe using the key proxy German 40 index. So before we start, let's take a look at the disclaimer slides first. Okay, so before we jump into the latest technical analysis on the various benchmark indices, let's take a look at the momentum, the raw momentum of the major stock indices across the globe. So what I did over here is that as usual, I break down according to last week performance, the prior week, and the prior 4 week average, and as well as taking into account of a simple momentum analysis by taking the difference between last week performance and the prior 4 week average. So what we could see over here is that last week the major U.S. Indices they actually start for the second consecutive week they actually declined, all right, declined. But the decline is lesser in terms of magnitude, as you could see over here, where the SPX for negative 0.3% versus a larger magnitude that was seen in the prior week, which is negative 1.87%. And the worst hit was actually the Nasdaq 100 last week. Why? As you all know that Nasdaq 100 consists of technology and growth stocks who tend to be very sensitive in terms of rising interest rates. So last week we start to have the release of the Federal Reserve minutes where number one, for sure the Fed will actually starts to rise rates this year. That's actually a done deal. So even markets start to price in 3 to 4 rates hikes per year, which is nothing new. Starting from the month of March, that should kickstart the first hike. And what's new over here in the Fed meeting and various official Fed speak is that the urgency for them to actually reduce the tremendous amount of worth close to 8 trillion over the decades plus of easing or easy monetary policy that blew that swell the balance sheet of the Federal Reserve Bank. So they wanted to actually rise rates as well as reduce the balance sheet at the same time. So that kind of freak out stocks globally, and especially those stocks that are dependent on leverage or dependent on borrowings to actually enhance their profitability and revenue, which the technology and growth stocks fall under this category, was hit. So that's what actually explained the negative 4.5% decline on the Nasdaq 100 seen in the prior week, also being the worst underperformer globally as well. But what's interesting here last week is that these losses starts to actually be negated, or not say or not, perhaps I don't use it, but negated has been minimized by the Nasdaq 100 having to actually close almost unchanged last week at 0.12%. For here, the Dow Jones also fell, but less than 1%, slightly worse than last week. Why? Because several key banks like JP Morgan actually give a weaker forward guidance that causes the stock to actually plunge close to about 4 to 6% plus on last Friday. So that kind of dragged down the Dow Jones Industrial Index, who which te- which has a higher weightage towards the financials. Then Russell, small cap, negative 0.8%. So Russell has been really been underperforming since the last 3 months. So I think that underperformance should actually continue this in the coming months ahead for at least this quarter. But one thing also good positive is that the losses managed to minimize from last week of negative 2.92%. But what's interesting on the highlight is I've been emphasizing since the start of the year or late last year that this potential outperformance on China-related stock market. Number one, because of their valuation is pretty cheap relatively to the rest of the world. And number two over here is that last year underperformance has been engineered by the China policy makers. So there are some hints that in the ground that number one, the harsher regulation towards the China private sector, especially the this technology sector, tends to be more toned down going forward. Why? Because economic working group, as being we call it chaired by top China policymakers, that's ended last year, has given the guidance of to be more pro-growth oriented in terms of policy making for this year. So that actually explains the anticipation of such policy. So what we could see as being reflected in the share prices of China-related stock market, which is the Hang Seng Index and the Hang Seng Tech Index, that actually outperformed this week by a very significant amount of 3.79%, and the Hang Seng Tech Index actually rallied at 4.82%, way above last week performance, and that could actually give us also its highest weightage, its highest score or value when I take into the momentum analysis of the difference between its last week performance versus the prior 4 week at 4.3% and 7.07%. So the Nikkei 225 managed to inch up again. That I'll share with you is that Nikkei 225 is still evolving within a triangle range configuration for the past 4 to 6 weeks, but still relatively slightly positive, 1.24%, erasing last week losses of negative 1.09%. And for the German DAX, it managed to actually shed negative 0.4%, minor loss last week as well. So now, before we go into the details of the technical chart, let's take a quick look at the sector performance. So the highlight of it is that the information technology sector last week was actually one of the worst performer, but this week it managed to erase last week, the prior week, I mean, talking about the prior week before last week. So last week managed to erase off its prior week losses to end us almost unchanged. So energy sector still remains the top performer for the second consecutive week. For the prior week, it was actually up close to around 10%, 8% plus or so, or close to 10%. Last week it was actually up 5.22%. So yep. So what we could see over here is the previous week sell off of the information technology stocks, right, seems to be losing a bit of downside momentum, which is actually relatively positive in terms of the what you call it sentiment towards the overall market. As you all know that information technology, even though it's considered as an important piece of the global stock market. Why? Because over the last few years, or in fact over the 10 years or so, the top outperformer has been the US big tech stocks globally, and it has started to suck in tremendous amounts of fund that required to actually outperform their benchmark. So they got to be in information technology. So as long as information technology doesn't collapse, yeah, it may be underperformed slightly, but as long as that certain key support still holds, I still do believe that from a technical analysis perspective, this ongoing bull run, yeah, even though it's coming towards the end, I'll actually highlight more in towards my Q1 quarterly outlook. It's more like riding on borrowed time. It could still continue to actually evolve higher in this couple of months. But in fact, it's actually climbing up in a wall of worry, but it's irrational. But irrationally, it can continue to last as long as support level holds. Yeah. Okay. Now, one piece I take a look at is the current sentiment of the market right now, by as implied by the SPX VIX index at the bottom. So what we could see over here is if the VIX index gets too high, there's a possibility of we call it, prior to that, there's actually a sell-off in the index, but the sell-off in the index has come to a turning point. All right. So now this VIX itself is what's my concern is that the index has continued to rally up since the low of 3rd of December, and now start to trade sideways after hitting this all-time high in late of last year. Okay, the current all-time high and starts to trade sideways. So in this sideways formation over here, what's more my concern is the VIX. So if the VIX gets too low, that means i.e. at 14.2, there's a potential risk of over complacency, means over optimism, where we could start to see another potential downleg, at least in the medium term. So what we could see now is that the VIX is still hovering in the middle so far, but hasn't reached this extreme optimism level of 14.2, which i.e. It could still support further potential upside, at least in the medium term. We're talking about multi-week for the SPX 500. All right. So now let's jump into the technical chart of the various major indices that I share with you all. Let's start with the SPX 500 first. So like I mentioned earlier, why I feel or why I have an opinion from a technical analyst perspective that the current rally from the low, means from the October low, is now evolving in a major topping process where we could start to see a risk of at least a 30% corrective down move towards the later part of towards Q1 or Q2 this year. Is because of this involvement in this bearish ascending wedge configuration. All right, that actually based on technical analysis, we call it a perspective, is actually not positive. Okay, and also if you look at the way the price action involved, you start to see a series of higher high, okay, higher high over here, but the RSI starts to shape a bearish divergence indicating to us that momentum is losing steam, but support still holds. So as long as support still holds, and from an elite wave perspective, it could still complete this bracket wave 5, which we are still expecting to unfold in this couple of weeks within Q1 to early part of Q2. All right. So this is the technical the way I call that, the top-down technical analysis that I'd like to start off with. So since that we know that its support still holds over here, the next key step over here is that we cannot be outright bearish. Yeah. So we got to allow the price action to actually continues to form. But bearing in mind over here is that since we know that it's in the midst of forming a major topic formation, we could actually control our risk if we want to be on the long side by having what we call prudent positioning sizing if we were to trade this SPX 500. Okay, so what we could see is that last week we have a pivotal support at 4608 tested, but didn't actually have a clear break below it. Hit the first resistance of 4750, and thereafter it shaped another round of pullback in the later part of last week. Okay, before stabilizing again, bouncing up very closely to the 4608 on last Friday. So what we could see is no change in our strategy, still using 4608 as a key medium-term pivotal support to maintain this irrational up move phase of a within a major topping process on the SPX 500 to retest 4750. Then a break above 4750 should take us up towards the next resistance level, which is a Fibo expansion cluster level 4830 slash 4860, which is so close to the upper boundary of this evolving bearish ascending wedge configuration as well. Okay, now moving on next to the tech heavy NASDAQ 100. So we could see the tech heavy NASDAQ 100 continue to hover above the 200-day moving average. So last week it did a bit of push down below our key medium-term pivotal support of 15,550, printed an intraday low of 15,163, but didn't actually have a daily close below it. Ended up with we call it a bullish dragonfly doji candlestick. And on last Friday, it retests again at 15,500, but also managed to have a daily close above this level. So what we could see is that this 15,500 slash 15,163, that access, which is close to the 200-day moving average, is a key pivotal support level, at least in the medium term for the NASDAQ 100, for it to enable it to actually churn higher uh, as well over here. So if you look at the daily RSI, is also supported by this key we call it corresponding support level close to the 34% level. Okay, so with that in mind, actually no major or no clear changes in our medium-term pivotal strategy. So what medium-term strategy, pardon me. So what I did over here is that I just add the excess last week low, the intraday low that was tested, but have a daily close above it as my pivotal support. I mean, I put it about excess on the downside at 15,160. So as long as 15,160 holds over here, I'm expecting the price action to actually retest 15,920, which was actually made last week again. A break of this level should take us in first step at least towards this descending resistance that is in place since the all-time high of 22nd of November 2021, now acting at the resistance at 16,570, which is also correspond to the minor swing high area of 30th of December and 4th of January this year. Right, so no change to our bullish buyer strategy on the NASDAQ 100, but definitely if we start to see a daily close below 15,160, this is where we got to be very cautious, where the price action should take us down towards the October low again for a very, put it in a way that for another round of a week of corrective decline to for 14,450 slash 14,380. Okay, now moving on next will be the Hong Kong 50 or the Hang Seng Index. Also, so still recall that over here is that why we turn bullish on the Hang Seng Index or the Hong Kong 50 because of the weekly chart that is actually banging off from the key long-term pivotal support at 23,000 level. It started to shape a series of bullish candlestick formation in the last 3 weeks or so. And why this level is important? Because it's actually the long-term ascending trend line that managed to help reverse significant corrective decline from a money perspective that is still in place since the great financial crisis low of October 2008. So what in store that we have for this week is that last week we actually mentioned the first resistance is at 24,450 for our bullish buyers. It has been met. Then after it started to shape a pullback, a minor pullback. So what we do over this week is that we're going to shift the medium-term pivotal support to 23,500. So as long as 23,500 holds, I'm expecting another push up, potential push up to at least test this intermediate descending trendline resistance from the 11 August 2021 high that actually prevented further rally in the past of 8 of September, 25th of October, and as well 16th of November. So now acting as a resistor at 25,200 in the first step. So still maintaining that bullish bias for that potential push up. But however, a 4-hour close below 23,500 should actually negate the bullish tone to see another slide to retest the long-term pivotal support at 23,000, and followed by slash the 20th of December 2021 low at 22,660. Now moving on with another major Asia indexes will be the Nikkei 225 or the Japan 225. So the Japan 225, as we highlighted at the start of my presentation, is still being congested or trading sideways within this 6 weeks plus, or in fact, yeah, since September. So it's about close about 3 months plus of symmetrical triangle range configuration since the September high, which is close to the 32-year high as well. Has been evolving in this symmetrical range triangle configuration. All right. So no change in that strategy over here. Is that the strategy last week is we have a key medium-term pivotal support at 27,800, which is the lower boundary of this symmetrical triangle configuration. So I adjusted the upside trigger level because as the price actually evolved, right, it's actually that line is actually sloping downwards, the upper boundary of this symmetrical triangle. So I slightly lower it to 29,050. So what is 29,050? If you look at from a Fibo retracement perspective, it's also the typical 76.1 Fibo retracement of a triangle formation over here, and also 76.1% expansion of the triangle low, taken from the low of here, projected to the low of 14th of Jan. Okay, so very clearly also, okay, so no, it's 1.236. Okay, 1.236. So we start to see a confluence of Fibo retracement and expansion level lying at 29,050, and now graphically, which is also the symmetrical triangle range resistance, which explain to us that this is a key level to actually watch. So that means i.e. you need to have a clear break, at least a daily close above 29,050, because has been evolving in more than 3 months, the symmetrical triangle. We need to have a higher time frame level close above to actually reinforce that potential, we call it a bullish breakout play that may actually arise on the Nikkei 225 or the Japan 225. So still no change, looking for a bounce towards the upper boundary in the first step of the symmetric triangle at 29,050. If we have a daily close above 20,050, then we could actually kind of validate a bullish breakout to actually test the this swing high area of 4th of November and 16th of November. Now I think as a as a resistance at 29,955. All right. So no major changes on the Japan 225, except that I adjusted slightly lower the upside trigger level. Then now moving on, lastly will be the German 40 index. So over here you will see the German 40 index. It has been slowly inching upwards in a series of higher high and now start to form a higher low. You could see over here, higher low on last Friday. So what's positive over here is that since hitting its close to its fresh all-time high level, which is at this range here over here, which is at 16, this region. Okay, at 16,290 level. That's the current all-time high area. On the 19th of November, tested it again very closely on the early part of this year, the first week of the year at 5th of Jan. Then ever since it started to trade kind of a higher high and also a series of higher low, which is positive, holding above the 100-day moving average and the 200-day moving average, both acting as a support around 15,600. Okay, so last week's strategy, we have a strategy where we put the key medium-term pivotal support at 15,600. So still no change. Price action kind of still trade above this level at 15,600. On the 4-hour RSI is being still supported by this ascending trend line support that is acting as a support at around the 46% level. So I'll still keep 15,600 as my key medium-term pivotal support for this week, okay, which is also the 200-day moving average and the 100-day moving average as shown earlier on the daily chart. So as long as this level holds, I'm still looking for a retest of the current all-time high area at around 6,300 slash 6,360. That's actually a bit of excess or above, slightly above the current all-time high area, which is defined by a cluster of Fibo expansion level. A break above 16,370 may take us up higher to the next resistance at 16,590. So, but however, if we start to see a 4-hour close below 15,600, there we may start to see another round of we call it sideways formation that start to form again to take us down towards the lower boundary of this major sideways range support at 14,920 slash 14,800. Okay, so to sum up everything, all the major indices that I covered so far are still holding on above their respective supports. So we are still maintaining the bullish bias for this coming week. Just bear in mind that we're going to be more cautious, especially on the leader, which is the US stock market. They're actually now evolving we in a kind of a major topping process, which i.e. Explain to us or indicate to us potentially whatever rally, potential rally that we start to see in the weeks going forward is more likely to be irrational rather than rational. Okay, so with that, have a great trading week ahead, and I see you again in my next video.